All right, so I'd like to get started real quick. We have our next presentation is going to be conversation is with Dr. Indranil Ghosh. He's the founder of Tiger Hill Capital. His book Powering Prosperity is winning international book awards all over the place. He has as everyone knows now who's listening to me, he has a phenomenal CV going back to being an MIT trained scientist to McKinsey, Bridgewater, was the head of strategy at Mubadala, the $240+ billion sovereign wealth fund out of Abu Dhabi. An enormous amount of expertise in private markets, ESG, impact, there's sustainability, a phenomenal thinker about the space on a global level, drilling down into actual practical investment decisions. And we're going to have Don Yoakum, very famous newsletter editor in the space, who's joining us here today. Go up here with Indranil because I am, as you probably noticed in my previous conversation, I am not financially literate enough to ask good enough questions, and so I've asked Don to go ahead and sit up here with Indranil and kind of talk through this presentation together. So thanks, guys. I'm going to hop on up there, and we'll get going.
All right, so I've had about 5 minutes to prep, so this will be a very hot seat, extemporaneous conversation. So, yeah, so why don't we just start talking, I'll ask you the big question that I have when I think about the ESG space, right? So on the one level, right, there's a lot of mandates around. So to me, that opens up incentives for greenwashing and stuff like that. So you have that level of it too, right? But on the other side, you've got actual efficiencies through, whether it's solar power generation, which is now cheaper than natural gas, other kinds of renewable and sustainable policies which actually improve the bottom line in a very legitimate way. How do you kind of look at that, right? What's your economic, what kind of economics are you looking at other than, softer, mandated things like, whether it's inclusivity or those sorts of things, or whoever else has a stake in whatever stakeholders there are. That doesn't drive up the stock price sustainably, right? It's the economics. How do you balance that, and how do you see through that to get apart from what actually drives economics?
That's a very good question to start with. And let me start by actually stepping even one step further back and asking the question, why does sustainable investment or sustainable investing exist in the first place? Why is it a phenomenon?
Mm-hmm. Yeah.
And what's it trying to achieve, and what is it? So again, going back to 2015, when the UN introduced the 17 Sustainable Development Goals, this was a declaration of a series of initiatives that need to happen for the planet to be on a more sustainable trajectory, particularly in two areas. One is environmental sustainability and averting climate crisis. And the second one is social inclusion, which is bringing up the living standards of the poorer economies, developing countries, but also the poorer and underserved communities that we have in developed markets, like the US and UK where I live. So these are the really existential goals of sustainable development, of the challenge that we face. Now, then the UN went on to quantify or try to estimate how much investment it would take to achieve these goals. And the analysis that they conducted led to a figure of $5 to $7 trillion per year for at least a decade, probably much more. Now, just to put that into context, the global GDP is $80 trillion. So that means that the global tax base is somewhere around $20 trillion. So if you were to try to fund that, $5 to $7 trillion per year, just from raising taxes, you'd have to raise taxes by about 25 to 30% across the board, and even higher in emerging markets because they tend to have lower tax collection because it's just harder to do that with the infrastructure that they have. So since we have, political meltdown, if we try to raise taxes by 1%, 25 to 30 is just not going to happen. So it's not the public sector that's going to achieve this. They certainly have a role to play. The tax dollars that are raised could be redirected and used more effectively to pursue some of these goals, and they are in many of the legislations we're seeing around the world, but it's not going to be enough, clearly. But the second lever you have, of course, is corporate investment, which is so critical. And so that is corporate profits being plowed into, for example, in the case of an oil company, instead of drilling more oil wells, building wind farms and solar farms, so becoming a renewable energy company, right? But even that won't cut it. So you'd still be left with about $2 or $3 trillion of investment gap to plug globally. So where's that going to come from? Where it's going to come from is stores of wealth, both public and private, and shifting that wealth into investments that can pursue advance these sustainable development goals. Mm-hmm. That's why sustainable investing is actually a mission-critical phenomenon, right. A trend that has to have the impact that we want it to have. So let's talk about where we are in that journey. Just like to show you a slide if this clicker would work. Thank you. There you go. So I looked at some data from the Global Sustainable Investment Review, and this puts into numbers the amount of money that's currently in ESG and sustainable investing. And you can see that there seems to be a rather impressive figure at the bottom there of $32 trillion that is being deployed in ESG investing today. But what is that really? So at least half of that is just exclusionary investing. So investing into funds and other vehicles which supposedly don't have any exposure to tobacco, guns, and increasingly to hydrocarbon. So that may help a little bit by tilting the cost of capital of these sectors to be higher and helping them to, or persuading them to change to other activities. In the middle, though, you see a bucket which is called sustainability-themed investing. And that has $2 trillion invested in it already. But the interesting thing is that's growing at 60%. It's an explosive growth. Now, this is in thematic funds like climate funds, social impact funds, and other things, which are, again, mainly in listed companies, but increasingly in private markets, but usually larger scale, larger cap investment opportunities. Right? But then at the top, you see that there's another bucket, which I'm calling impact unicorns, getting to your question, which is only about 0.2 trillion, right, 200 billion, and is only going at 20%. Now, this is the capital that would go into companies that are not just cleaning up the way they do business currently, or investing in large-scale businesses which, like renewable energy, could have an impact. This is capital that would be going into truly disruptive businesses that are changing the way business is done or technologically an industry operates, and in a way that could have very big direct impact. So these are game changers. Yeah. Now, the fund that I'm starting in Q1 of next year, which is on sustainable infrastructure, falls in that middle category, the really fast-growing one. So we're going to be investing in energy storage, clean fuels, clean mobility, all sorts of large infrastructure projects, deploying hundreds of millions of dollars of capital per transaction, right? But if our sector is growing at 60% and is at 2 trillion globally, but it's being fed by an engine where there's only 200 billion, and only growing at 20%, that shows you immediately that there's a big bottleneck in the market, right? To really get the disruptive technologies, which just change the economics of an industry and make it wildly more profitable inherently, so they're profitable from day one, and have a big impact. If we're going to have to, push those companies through the funnel, we need a lot more, capital allocation at the top of this pyramid. And this is where I think the opportunity is for the financial publishing industry, because by mobilizing individual, retail capital, and the sort of access that you have to self-directed investors into the top of that pyramid. That is the way to unlock the entire sort of sustainability, sustainable investing bottleneck.
So that bottleneck exists because most, I'm going to make the statement, you tell me you're right or wrong or correct me. I mean, VCs continue to move up and up and up as far as what their minimum investment is. I mean, you got $50 million, $100 million now is kind of the threshold for a lot of them to look at. So they just can't even, I mean, they'd have to do 100 to 200 of these different investments, which is just way too much for them to manage. So that's where, in any kind of, on the Reg A phenomenon, Reg CF, and along with all of these other, how they raise the money, but this kind of middle tier of companies that need $5, $10, $20 million, right? And they just can't get the attention from the big guys, but they just need that exposure, right? So that's a gap. So there's this massive gap that's just creating this vacuum. That's an opportunity, right, for the retail.
That's exactly right. So when you look at the venture capital industry, first problem is that the average ticket size is getting higher and higher, because capital tends to get concentrated into the most successful GPs.
Yep. Oh, and they also only have so much attention, right? I mean, there's only so many things they can pay attention to.
And so there's just a minimum size that they can work with. On top of that, there tends to be a concentration in certain sectors, right? So it's technology, it's crypto, it's biotech, it's a few things, but not enough towards the kind of much more capital-intensive, hardware-intensive, manufacturing-intensive companies that we need to promote if we're going to clean up big sectors like energy, big sectors like agriculture, transport. For this type of stuff, you don't just write software. You have to build stuff.
So that's the characteristic of this sector is very capital-intensive industries for the most part. Is that right?
That's right. And so often the cycle that you see for one of these companies is that it needs, 1, 2, 3 million to develop some technology. Then it needs, maybe another 5 million, 10 million to develop or 5 million to sort of do a pilot plant or a pilot project of a small scale of infrastructure to show that the thing works. Then it needs another 10, 15 to develop its first project. So work with customers to get long-term purchasing contracts for energy or whatever they're producing, to get the land and the permitting to build a factory. So it's quite a long and expensive process. So that set of activities is usually the bit that's quite underfunded. But when you get to the stage of having the first factory ready to build, then as that chart is showing, lots of funds that are growing at a very rapid rate, ready to fund that first project when the hard work is done. So from my perspective, in order to have good deal flow and not be fighting with all my competitors, I need to make sure that the top of the pyramid is really well nourished.
That's right. Yeah. No, that's great. So, give me a couple of instances. So, like in Iceland, right? They just launched a carbon capture plant, right? Very curious about that. Kind of certainly small scale. Have no idea how much capital went in to actually build that thing, right? But if you of the things that you're seeing as far as these potential impact unicorns, like what's the one, like one or two things that just feel most exciting or most impactful, both from an investor standpoint and actually in achieving goals?
Well, a couple that I really like are agriculture-related topics like vertical farming or regenerative agriculture. The area of clean fuels, I think, is really interesting. So similar to what you're talking about with this project in Iceland, there's another series of companies out there. What they're doing is they're taking renewable energy from wind, solar, maybe hydro energy, and using it to electrolyze water, to split water into hydrogen and oxygen. And then they take that clean hydrogen, and that could actually be used as a fuel directly in certain situations or as industrial feedstock. But what you can also do is, through a relatively inexpensive chemical reaction, combine it with carbon dioxide that's given off by some industrial process. Say it's a brewery or a refinery, which would otherwise go into the atmosphere. So you do the chemical reaction, and you get back to a fuel, like kerosene or methanol. And given that aviation and shipping and heavy-duty road transport are some of the biggest carbon emitters, if you can take carbon dioxide that would have otherwise gone into the atmosphere and make it back into a fuel, with clean hydrogen, then you've gone a long way to clean up the mobility sector, but in a way in which doesn't require too much changing of the actual planes and
Right, exactly.
ships, because
So
you're
is
still
that
using the
true?
same fuel that you were before. It's just
Yeah.
made more cleanly.
Right. So is it so in your view then, do you think that it's going to be liquid fuels with much higher energy densities, although you lose a lot of efficiency in conversion, right? And combustion engines are maybe 25% efficient if you're lucky, right? So so is it that process and maintaining the liquid fuel infrastructure, you know, whether it can be ammonium hydrate from hydrogen, you know, or anything like that, other fuels like you talked about, or is it lithium tech, like lithium-ion batteries? I mean, which, you know, if they work on the energy density problem, if they can break through that over the next 5 years, you know, then it kind of becomes on par. What do you think is how it's going to break that way? Or are they? I mean, and you could maybe you can cop out and say it's going to be some both. But you know, give me one.
I'm going to say that let the market and the innovation of the industry decide, because I don't think we need to make that call.
Right. And it's too hard to tell, right? Because the economics are so similar.
We simply don't need to make that call, right? Because there's going to be certain parts of transportation which are just very hard to do with hydrogen or with a battery.
Yeah.
The battery's too heavy. The hydrogen doesn't have enough energy density. So until the technology is there to power a plane with a battery with enough energy density and and so it's light enough, or you know, what can we do? Well, we can go with clean kerosene. So you're basically not changing anything about the way that the plane operates. It's the kerosene
Converting it back to
is
what it was.
cleaner. Now, if it could be run on a battery which is fully, you know, powered by renewable energy, well, that would be fantastic. But maybe we need 10, 20 years for that. So we need transition technologies just as much as we need, you know, an end state solution that is completely carbon negative, maybe, if not carbon neutral.
Great. Well, I don't know if you got appreciate that answer. Have you got more of this, or I didn't know if you got.
One of the things I think
I didn't get prepped in advance too much. I didn't want to talk.
Well, we don't have to look too much at the slides, but I think one of the things that's probably worth talking about is, you know, if sustainable investing is going to work, and if we are going to actually have the kind of societal change that we need to be more sustainable, a lot of stuff is going to change. The whole system needs to change. So sustainable investing is predicated on a broader system change. Otherwise, it's not going to work. Right? So is that going to happen? I would say that's almost a fundamental question we have to answer first.
So another aspect of that, okay, so you've got this from the technology on the climate side, right? And so that's a clearer payoff, right? Then you've got the social side, and you referred to it earlier, and it's actually something that's pretty intriguing to me, is how do you unlock that capital, the native capital, you know, that are in underdeveloped countries, or you know but that capital isn't liquid right now, right? And to my way of thinking, so much of that has to do around property rights. Sometimes in some countries that's well defined, in some countries it's poorly defined. What do you see happening as paths to, you know, more clearly defining those property rights, and then the mechanisms that they have in order to, you know, make that liquid, you know, allow them to monetize it?
Property rights is a fundamental issue, as well as just general business friendliness practices, like being able to get your money in and out of a country easily, having a well-administered tax regime, and so on. And being able to get permits, being able to start a company quickly. So there's a lot that can be done in all countries, but particularly a lot of emerging markets where these, you know, capabilities aren't there yet to sort of make those legislations more business friendly. But I think the next step, you know, once that basic framework is in place, and maybe this is where I will use one or two more slides. How do I go back? Is talk about what else is necessary. Now, this is a chart that I find very interesting, because this actually, although mostly focused on developed markets, is even more true of emerging markets, particularly in large cities in emerging markets, where what you see here is the real cost of different things and how they've evolved over the last 20 years. And what this chart shows is that some very basic things like healthcare, education, housing, transportation, they've gotten, in real terms, much, much more expensive. And that's even truer in places like Mumbai and Shanghai, where you've had massive concentration of people in a short time into cities, right? But at the same time, electronics, cars, clothing, it's got cheaper. So the way I say this is stuff got cheaper, but life got a lot more expensive.
Yeah.
Now, the more that life gets expensive, it means that people are locked out. They don't get access to developing their own human capital. If they're not healthy, they don't get a better education.
They have no savings.
They have a poor, housing conditions. It's very difficult to become the best version of yourself and be productive as you could be, which is a very big shame economically, right? And actually comes back to haunt economies and actually ends up hurting things like the birth rate. So as part of one of the contributions to falling birth rate is this lack of access. Right? So one of the things that's really important to fix on the social inclusion side is to improve access to all of these life factors, these basic factors. And that's where I think we can use not just technology, but improvements in zoning laws and community investment, laws around enabling regions to be more in control of their finances, to invest in things that are most suitable for them to become competitive in the global economy. By sort of investing more into these more basic, more fundamental things about life and these sort of social services is absolutely critical to upgrading human capital, which is ultimately the driver of all productivity. Because with that, you get more innovation, more wealth creation, and more investment into further sustainable development. So it's a
So where does that fall? Is that more governance or less? Is it more structure or less? What's your view?
It's got to be a bit of both. That's where it's not a cop-out, but that is a partnership. Okay. So you've got to think about what is the role of the public sector and what's the role of the private sector. Now, at least in my view, the private sector is really good at making short-term investments into lower risk, surer bet type of commercial activities, right? And it's very good at allocating resources to make these short-term investment decisions. Whereas not so good is taking a very long-term view. We're talking about decade-long, multi-decade view, which is what we need to take when it comes to sustainable development. It's not necessarily good at taking very early-stage risk, as that pyramid showed. It's not good at investing in basic science or even translational science, for example. And so there's a role for the public sector to take on some of those responsibilities by incentivizing innovation, not picking winners, providing more incentives for technologies and businesses to flourish in all these different areas. So no need for the public sector to choose whether it's going to be batteries or clean fuels. Just support them all, as the Department of Energy is doing with its loan program right now, for example. So incubation, smart incubation, but without picking winners, is an important role for the public sector. Having a longer-term view, being able to provide longer-term capital, which will help some of these companies that we saw at the top of the pyramid bridge through, over several years of development to being ready for private funding. These are the kinds of roles that the public sector, I think, can play.
Can step in. So at the back to the top of that pyramid on that unicorn side, I mean, how many different companies are in in some do you see in a viable position that would warrant investment? Like, is it hundreds? Is it thousands? I mean, if you look at the numbers get pretty small sometimes for the companies that as I look across it, but that's usually just in the U.S. So, like, how wide open is that field as far as people in different initiatives? I mean, is it thousands?
What I'm seeing is there's thousands of companies. There's actually a huge, blossoming of innovation in both the zero carbon as well as the social inclusion companies. And frankly, they're starved of capital at the top of that pyramid.
Yeah.
I'll just show you, again, another slide, which is this is just some of the deals that I'm working on. So one guy and his team, okay, all sorts of deals across all of those themes, which a lot of them are to do with, green energy, clean industrials, clean transportation, food, water, and waste, also a bit of social inclusion. Now, the numbers in red are the amount of capital that's required to get through that early stage, to develop the technology, build the first pilot plant, put in place a project, develop a project that could then be a full-scale commercial plant but needs the next round of funding. The numbers in black are that next round of funding. Okay. So you can see that just on this page, what I've curated is multi-billion-dollar pipeline.
Right. Yeah.
Right? The right-hand side is what funds like mine can do later on.
Yeah.
And that's about 5 billion or 4 billion on the right-hand side in black.
Yeah.
On the left is about 500 million.
Yeah.
That is a funding gap because very few of those companies have yet found VC funding. Some of them have, and eventually they will.
Are many of them just still on paper then? I mean, if they, if funding is scarce,
they've gone to their friends and family. They've done a few family office
maybe
rounds.
some minimum viable product.
So they're in operation.
Okay.
Right. But to make it to the stage where they got that first commercial scale project, they need a proper slug of capital.
Yeah.
Right. And many of them will get that VC funding or funding from some source.
Yeah.
It's painfully slow.
Yeah.
Right? It's going to take a year, 2 years. And this is where, by mobilizing the financial publishing industry, being able to get self-directed investors into these types of deals at scale, at high velocity, we're going to unblock this sustainable investing problem and actually accelerate all the things that we need to do to decarbonize the planet and have somewhere livable 20, 30 years from now.
Excellent. Any questions? You guys jump in at any time.
Thank you. On the slide about life getting more expensive, healthcare is one of the things that got more expensive. And I think personally, even doing pretty well by societal standards, I know that healthcare costs are a non-negligible source of stress in my household. And if it's a stressor for us, then I think the average person in society is hurting even more. This is also true in China. I lived in China for 10 years, and even people who were in the upper half of society in China have this concern around healthcare. It seems to be a kind of global problem. I also notice it's missing from the pipeline slide. And so I'm curious, how does sustainable investing and/or the kind of just general elevating of standards that everything you're talking about represents with regards to investing hit healthcare? What are some examples that might look like? They don't have to be tangible, but just like, what does it look like? How do we think about all of this stuff as it intersects with healthcare?
Again, I think with healthcare, we've got to focus on the services which, if you provided really well and relatively in a low-cost way, but a high enough quality way, would address 80 to 90% of all healthcare issues. And those are things like vaccination. It's like preventative health. It's actually things like encouraging sports and well-being very early in the education system, so you set good habits. There's a very good initiative in Iceland, coming back to Iceland, a few years ago. They found that all the young people, because there was nothing to do in the cold winter evenings, were just going out drinking. So there's becoming a sort of a drinking problem, which is obviously having a health impact and also just general productivity impact on the economy. So what they did is they really started to promote sports and well-being in the schools, and they found, and they provided recreational facilities, right, for people to go and play a sport indoors during the long, cold winters. And lo and behold, drinking rates fell, health improved, educational attainments improved, right? So healthcare isn't always just about literally hospitals and medical technology. It's actually impacting the whole lifestyle and culture of a generation that can have huge health benefits. Okay, but then of course, you actually have to have healthcare. But it turns out that of all of the medical procedures that there are, the thousands and thousands there are, there's only about 20 or 25 that really address that you absolutely need, but need to provide to everyone to address 80 to 90% of all the sort of surgical issues that are required. And those are things like childbirth, appendicitis, sort of common but simple interventions, but you need to have clinics everywhere, all around the country, providing that in a low-cost, easy-to-access way. So making those types of smart investments actually improves healthcare outcomes significantly. Whereas what we seem to be doing is spending more and more money on drugs and very expensive medical interventions because we didn't get the upstream part of it right, which is improve good, healthy lifestyle.
Yeah, and that's kind of why you don't see it on there, right? It's healthcare that you're talking about, basically more doctors and infrastructure. It's not that investable. Doctors and the infrastructure absorb most of the costs, right? And rightfully so, right? And that's why the investment is going to drugs, because those things have a payoff for the investor. So it's really a social balancing problem of how do you either encourage more hospitals, how do you encourage more healthcare, how do you encourage more vaccination rates, right? And this it's not as directly investable, I think, would be my theme there.
Healthcare, like prisons, is an aspect to that, which is really a public sector activity.
Yeah.
It needs to be funded appropriately and efficiently through the public sector. But then above a certain threshold, more elective and complex surgeries and therapies, which are inevitably required, maybe that's more of a private sector issue. But I think there's a lot more investment in that upstream social healthcare that needs to happen. That's not to say that healthcare, and there aren't a lot of great healthcare companies to be invested in. I wouldn't say that it's not investable. It's just that if you're trying to get sustainable outcomes, I think you need to focus a lot more on these health and well-being aspects of healthcare.
You had mentioned crypto as an investment vehicle in the beginning, but my question would be, with all of the miners, not just with China, but all over the world that are coming to the U.S., and the energy needs that they're going to require over the next 5 to 10 years, multiple gigawatts, do you see a lot of sustainable investment going into that industry? Because, in my opinion, the U.S. at some point is going to require a certain amount of sustainable energy for these companies as they let them all in. And then they're going to tax the heck out of them. But
which companies that are letting in? I didn't quite hear you.
Oh, you're talking about all the mining companies, all the crypto miners, manufacturers, Bitmain, Canaan. They're all here. They're all coming here now. They're snatching up all the land, and they're building mining factories, and they're using all different types of energy. So, that's the plan for the next 5 to 10 years. They want to come to the U.S., and it would seem that there's going to be a requirement at some point that a percentage of their mining is going to have to be coming from sustainable energy.
This is actually a really important point because it's not just crypto,
right?
But it's data centers.
Right.
So the whole digital ecosystem runs on an enormous amount of energy.
Huge.
And so, when we talk about the energy transition, and people think it's just about wind farms and solar plants, it's really not, because the energy content of so many industries is incredibly high. And digital industries, crypto, data centers, is absolutely in the
far surpass some of the things that are happening now. Massive amounts of energy are going to be required.
30% of food production is actually energy. So the reason why vertical farming, in my view, is an impact unicorn area is because if you have an indoor controlled environment growing facility that's very, very large scale, like we're looking at something in New York that's 400,000 square feet, 7 football fields, that's run on renewable energy and manure digesters, so it's consuming its own renewable energy and has enough left to sell back to the grid. These are very disruptive business models because you transform the economics of food production completely. So traditionally, in normal agriculture, you have sort of an EBIT margin of 10%, right? Because you're paying for the fertilizer, you're paying for the energy in one way or another, right? You're paying for a lot of machinery. But if you're doing that in a much more controlled environment where you're growing 24/7, 365, right? In optimal conditions, you can grow fruit aseasonally, so get higher prices because you're growing it in winter. And at the same time, your energy bill, is almost zero because it's coming from your solar panels. And the sort of the agri-waste that you're producing, you can actually sell it as fertilizer, as compost to other farmers. So things that used to be costs in normal farming are actually revenue streams, because energy is now a revenue stream. You're selling the surplus to the grid. You're selling your agri-waste as manure. Your EBIT margins go up to 70, 80%. So you're having a great deal of impact. You're also able to locate that vertical farm right next to a city and not have to transport the food from Arizona or California. So the carbon footprint impact is huge. You're hugely profitable. But going back to your question, I think when it comes to digital, these are also very disruptive technologies because they can have a big bearing on disrupting and making more efficient other industries, right? But the energy component of it can't be ignored and needs to run on renewable sources, which is why we need to continue plowing more investment into all kinds of new renewable energy facilities.
Right. They'll pull on whatever source of energy is out there, and if it's more sustainable, then that helps solve that problem. On the CO2 front, right? And so the various different bottom-up type of initiatives that are tackling them. One of the major contributors is just simply plowing the land in the spring, right? I mean, that throws up almost more than I think automobiles, right? And so what are, apart from the vertical agriculture, right? Are there other initiatives, technologies, just methods of trying to get people to change their habits? What do you see as far as a way to impact that?
There's a company on that page right there that addresses that problem.
Huh?
So it's a company called Novihume. It's a German company.
No what?
Novihume.
Novihume.
What it does is it takes brown coal, which is lignite, excavated from a coal mine, and instead of shutting down the coal mine, you continue to dig the coal, which is good for the workers. But now you treat the coal with a proprietary approach, and you create a soil enhancer. So you apply a soil enhancer to the fields, every year, and you don't need to apply any fertilizer because what it does is actually improves the soil structure, increases the growth of the root structure on the plants. And what you end up doing is actually increasing the carbon content of soil after several years of application, and increase the nutrient levels, and ultimately the nutrient levels in the food that's grown itself. Yeah. So instead of normal agriculture, which you absolutely rightly pointed out, leads to carbon being released from the soil because you're plowing it every year, it's sort of lying fallow, it's blown away, all the carbon dioxide sort of goes into the atmosphere.
Plus all the nitrogen, which was produced through carbon-intensive processes that goes on the fields to begin,
right.
On top of that, yeah.
Instead, you apply Novihume, and actually improves the soil structure, sequesters carbon from the atmosphere, and gives you higher quality food. And combined with crop rotation and other regenerative agricultural processes, right? You end up making your soil richer and richer every year. Mm-hmm. And this has been proven through 12 years of research, right? On fields side by side, farmed regeneratively and farmed conventionally. Right. And you see the complete differences in soil structure, carbon content, nutrient levels. Yeah. So it's this kind of technology. It's a perfect example. People think we coordinated beforehand, but we didn't. Perfect example of the kind of company that's looking for funding and is finding it painfully slow, but could be accelerated significantly so they could start building a factory in Germany and in the US and help support this regenerative agriculture movement.
Now, is there a mechanism for, John, how are we doing on time? Wrap it up? Okay, all right. I'll just skip my last question. I'll open it up here for one last question from anybody out there. No? Okay. All right, well then, thank you. This has been a great conversation, everybody. I appreciate your patience with this kind of winging it.
Thank you, Don.
Thank you. That's a great conversation.